It is a corporate entity that is legally registered and would conduct business in a jurisdiction or country with lower taxation than the home country where the owners who are controlling the business are resident. And that was a high-level definition for the CFCs, which stands for Controlled Foreign Corporations. Hello everyone and welcome to the Tax Gate. Hit the subscribe button and let's get started. So, why CFCs? Well, controlled foreign companies would be normally used in tax planning when large corporations transfer their assets to a foreign company within the jurisdictions with low tax rate than the home country. And normally such would include dividends, interests, royalties and capital gains that would be typically directed to the CFCs where the low tax rate is applied. So, it would be all about the activities of the foreign company. If it does not have a real benefit to the local economy, then it is likely that the income or gains derived by this foreign company would fall under the CFC provisions affecting substantial shareholders in higher tax locations. And here we should highlight that countries have implemented anti-tax avoidance measures like CFC rules to prevent individuals and businesses from minimizing their domestic tax liabilities by taking advantage of low-tax jurisdictions. So, CFC provisions normally operates by bringing the profits of the CFC into charge in the jurisdiction of the parent when they are made. Well, so talking about CFC rules and provisions, we would mainly cover the following. First, the level of control over a foreign company. One of the main assessments to identify a controlled foreign company is the level of control either directly or indirectly that a person with a residence or a presence in a territory would have over a foreign company. Also, it would depend on each jurisdiction which percentage of control would be sufficient for a company to be defined as a controlled foreign company. Also, we would have lower level of taxation test. Several countries would have a lower level of taxation test in their CFC provisions, bearing in mind that some countries wouldn't formally specify a specific level of tax and would rely only on either the level of tax in the overseas jurisdiction is significant or not. Another element to be highlighted here, which is the type of income earned by the foreign company. And here the types of income or gains earned by the foreign company would be one of the indications that would help in defining the controlled foreign companies, and as we highlighted at the beginning of our video, that this would include dividends, interests, royalties and capital gains as well, and almost all the jurisdictions would view that such passive income or investment earned by a foreign company should not remain untaxed or subject to limited taxation in the foreign jurisdiction. And finally, let's highlight that further tests would be in place depending on the CFC provisions that each jurisdiction would have. Like and subscribe for interesting tax videos to come, and thanks for watching TaxGate.